Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to go ahead and review stocks, and specifically stocks and currency, and stocks relation to the currency markets, or what we like to call foreign exchange. So without any further delay, let's go ahead and review all these key stocks and the markets in general. Alright, right now I'm going to go ahead and review the dollar index. Dollar index did get a significant bid today on today's trading session, and as a result, the Euro-US dollar has had a pretty decent decline. Again, this area doesn't exactly resemble much, if anything, except for the 1.4, right? Perhaps this area right here, but that's at 1.46. Probably have to drag or create their chart a little further back to figure out why exactly this area is not being penetrated that well, and basically you're seeing the Euro-US dollar pull back. Let's go ahead and extend the lines and figure out where in the world this might lead us to. So again, it's not exactly a significant area, but it's still an area that the Euro-US dollar is pulling back from, and as a result, stocks are having a significant decline. So the most significant part about it is probably this trend line breaking below this area at the 1.4 for 1.5, 1.45, somewhere in that area, 1.45 to 1.46. Key point is that we're still in a downtrend on the Euro-US dollar. So let me go ahead and move these trend lines a little bit, and let me go ahead and try to explain what's going on with the Euro-US dollar. You see this, right? And this is it kind of looks like it, but here's the issue here. You're having lower highs still, and if it pulls back from this area, you know, the only place I could imagine it finding support at is the 1.40. But if it wants to continue the downtrend, it would have to break below the 1.40, and that means bears are still, you know, bulls don't have that much confidence in this rally. Now, the only thing that's really driving up the euro at this point was the stock market rally and earnings holiday season, or what we like to call in the stock market earnings season. And what happens in earnings season, at least after the Great Recession, was that stocks would typically rally after prior to earnings season, and that was kind of what signaled the end of the 2009 March lows. We were running into earnings season. Earnings seasons did blow out expectations in a very, very big way, and because of that, stocks rallied by around 10 to 20%. And from that point onwards, stocks tend to, a lot of people in the markets kind of smartened up to that and said, we're going to buy stocks prior to when earnings are announced. And this is kind of what's going on with the Dow Jones Industrial Average. It used to not be that way, not in such a significant degree. But if you're starting to see major indexes move up by 5 to 6% and fall right after earnings come out by around 3 to 5%, you know, the seasonality of markets are starting to really show itself, especially because of our whole entire knee-jerk reaction to how we basically this whole entire reactionary environment is kind of based on the post-Great Recession era. So what I want to point out right now on this chart, which is very important, is this pattern right here, which is kind of a cup and handle, and you can sort of see it. But I'm going to pull it out to a longer-term chart, and I'm just going to go ahead and point out to you guys something very significant about this, because you got a cup, and you got your handle right there, and you got a cup right here. Now I'm going to go ahead and zoom out, and you guys can see the significance of this 5-day surge. Now the likelihood of you being able to sustain it isn't that high, and if it does happen, you could probably break above the neckline, and you could consider this perhaps you know, you could probably see the 12,800 area pretty soon, and perhaps the 13,000. But it's not like the economy has very, very stable footing. There are many things we're uncertain of. We still have a double-dipping housing market, and as far as the permanent open market operations and whether the stock market has factored it in or not is left to be seen. The main reason why it's hard to factor it in is because, you know, it was not only a psychological phenomenon, but another thing about permanent open market operations and quantitative easing in general was that it honestly pushed bond investors out of the bond market into the stock market. Basically, you need a consistent flow of money to accumulate stocks. You need a consistent number of people trying to buy stocks, and on a consistent basis. Now, I don't know if there's accumulation distribution on this chart right here, but yeah, I don't have it on here. I do have it on my Scottrade chart. But basically, accumulation distribution, for a stock market to sustain its rally, it requires much more shares being bought today than there was bought yesterday. So again, right now there are more shares being bought today than there were back in 2007. But it's still not enough to push our markets back up to around the 14,000 area, because fundamentally it's not well supported or justified to be buying stocks at such ridiculous valuations. So again, the point here is that this market has resistance at this area, and you know, and for me personally to say whether or not this area is a good area to be buying, I think it's not. I think in fact this area could pull back for a significant decline, and not too significant, but you can see a 1, 2, maybe 3 bar surge to the downside before it continues going up higher. The markets do seem a little exhausted, and you can see like a 3 bar pullback like right here. And if you see a 3 bar pullback, maybe the 20-day moving average will act as support, maybe the 50-day moving average will act as support, or maybe it finds support in between those areas. But regardless of the case, would I still be buying into those index ETF call options or anything like that? The answer is no. I wouldn't be buying anymore. And therefore, for that reason, just to be very watchful of the Dow Jones Industrial Average. And another thing that I want to point out is that you do have star pattern and rising star, and these are pretty bad, because if the markets continue to trade flat as they have been today, and if they close flat like that, which they most likely will, regardless of whether it's negative or positive close, if it stays like that, that is a topping pattern. So a topping pattern along with a double topping pattern on top of the fact that it is a cup and handle pattern that can't really break its neckline, you go ahead and pull back, and you see the Euro-US dollar pulling back a little bit, and it is continuing its downward trend. And you also consider the fact that the US dollar index is getting a pretty decent bounce. You would have to say that it is a bad idea to be buying index ETFs or stocks in general at these levels, unless if the stock is undervalued. And one of my stocks that I really do like that are a little undervalued. I need to go ahead and pull up the chart real quick, so just give me a second. So this stock is basically AMD, and if you guys watched my previous video, but if you haven't, I'm going to go ahead and show you something interesting on the chart. You got this breaking above right here, and then not only that, you have a previous area of support. So a previous area of support and the chance of it breaking out of a channel means a very, very great buying opportunity, especially because this channel is a multi-month channel. And whenever a chart breaks out of a multi-month channel and a multi-week vertical channel, one could honestly say, you got a multi-month support area down here, and then the channel lasted for a couple months actually, and it's starting to break out from it. This is the type of chart you want to be buying into, because this has a lot of power inside of it. You're also seeing a humongous percent K breaking over the percent D. I already bought in my stake inside of AMD, but basically, this is kind of what I look for when I'm trading, and this is kind of the opportunities I would want to have. So again, when I trade, this is the type of setups that you generally want to look for, especially the breakouts, because I think this chart has a lot of opportunity to break out much higher than $7.14. So again, this is what I like right now. Another thing is the volatility index. Volatility index did have a pretty bad day today, and it requires much more than a flat, slightly negative day for the volatility index to go up. You would need at least a 1.5% to a 2% decline, anywhere between that, for the volatility index to have any significant bid inside of it. So again, if you're trading the volatility index, I'm not really big on buying the volatility index. I do like shorting the volatility index, but I don't like buying it, so not anymore at least. Over the longer term, it's much safer to short the volatility index whenever the markets go up than it ever is to buy the volatility index whenever the markets are going down. If you see a market pullback, it's much smarter to short the SPY, buy put options, but never try to buy into the volatility index or buy call options. In fact, that's kind of sort of my rules when it comes to the volatility index. Moving on, main point here is that the volatility index could have a pretty decent bounce in the next couple days, but I would much rather short the general market like the SPY ETF or buy put options on it with a small portion of my money, rather than trying to buy call options on the volatility index. Just what I've learned in the past. It's not a very good idea ever. Okay, moving on, e-commerce ding ding. This is basically China's version of Amazon.com, except it's very small growth phase. It's the company's market value or market cap is at 800 million. One would honestly have to say, for a country that's about to become the second superpower, if you were going to invest into a company and it had a population of, and you're investing into a company that's located in a region that has a population of 1 billion people, and they're also a consumer-based economy, believe it or not, China is not much of a manufacturing-based economy, at least not anymore. So a vast majority of its GDP production is done by consumption, not by production. That's why I kind of cringe my nose whenever I hear people saying, oh, China has the greatest manufacturing economy in the world. Wrong. It has one of the fastest growing consumer-based economies in the world. Just like the USA, China's just shaping up to be very similar, if not the exact same thing. But moving on, the main point here is that China ding ding, consumption, consumption, consumption. If you want to take advantage of a consumption-based economy that's continuing to grow at a very rapid pace, it's obvious you want to buy an internet e-tailer, just like e-commerce ding ding. This stock is relatively cheap. It did rally by around 4 to 5% after I gave a recommendation on it. Still, I think there's much more room to the upside, but it will trade relatively flat for the rest of 2011 in my opinion. However, over the next 5 years, a stock like this will produce substantial returns, especially at these type of valuations. Okay, moving on, let's go ahead and review the next chart, which is Sina. Sina does have a resistance area right here, but it's also having trouble breaking out of the Bollinger Bands. If it does eventually break out, I do see a great shorting opportunity right up here at this trend line, which is basically at 126 to around $125 would be your area of resistance, or where you would want to short. Moving on, I also have another chart, which is QQ. QQ is having a hard time breaking out of its vertical channel, and again, slanted channel, whatever you want to call it. If it does break out of here, I do think the 50-day moving average could be a short-term short scalp, and then after that, you would want to short at $26 and then perhaps $30. But I don't really see $26 and $30 in the books. I'd much rather think that we're going to get close to $24 just at the 50-day moving average and the support or resistance area right here at around $24, and that's only if it breaks out of the $23 channel area. So again, shorting opportunity perhaps in QQ, perhaps immediately right now, but if you want to wait and observe, perhaps the 50-day moving average is a better place to wait for a short. Okay, so that's all for today. If you guys have any questions, leave a comment right below on my video. And if you guys are interested in my videos, be sure to go ahead and subscribe. I'll have more for you in the weeks and months ahead. And if you want my charting software, be sure to go ahead and check it out right below on my video. Right below, there's a link for all of you guys. Take care, folks, and we'll go ahead and see you all next time.